Hey savvy investors! Today, I'm thrilled to share some exciting news that could be particularly interesting for fellow dividend hunters who, like the Dividend Uncle, are always on the lookout for consistent income streams. The J.P. Morgan Equity Premium Income ETF, or JEPI, has recently listed on the London Stock Exchange or LSE. For income-focused investors in Singapore, this listing presents a fresh opportunity to explore this globally popular income-generating ETF. Why is this a big deal? Because now investors can receive JP's monthly payouts, without the hefty 30% U.S. withholding tax that used to apply when it was only listed in the U.S. market. In this video, I'll share factual information about how Jappy works, discuss its performance history, and consider the potential opportunities and risks it offers. By the end, you'll have a clearer understanding of Jappy's structure and whether this type of investment aligns with your financial goals. But before we dive in, let me be clear. This video is for educational and informational purposes only. It is not financial advice. Always consult a licensed financial advisor for advice tailored to your financial situation. I may hold positions in the investments mentioned, but my decisions may not be suitable for everyone. Alright, let's dive into the world of Jappy and see what makes this ETF so popular in the US, and the role it could play in your dividends portfolio. What makes Jappy unique? The covered call strategy. So, what makes Jappy stand out from other dividend-focused investments? It's all about the covered call strategy it employs. Let me break it down. Jappy invests most of its assets, around 80%, in a portfolio of large-cap U.S. stocks. These are companies with lower volatility and strong fundamentals, providing a stable base for the ETF. But here's where it gets interesting. Jappy uses the remaining 20% to implement a covered call strategy through equity-linked notes or ELNs. Now, what's a covered call strategy? Think of it this way. Imagine you own a car, but you don't use it every day. Instead of letting it sit idle, you rent it out to earn some extra income while still owning the car. That's essentially what Jappy does. It rents out the right to buy its underlying stocks at a predetermined price by selling call options. In return, Jappy collects premiums from these options, which contribute to the ETF's monthly payouts. The beauty of this strategy is that it generates consistent income, even in volatile or stagnant markets. Its dividend yields of the US-listed version range from 6% to 12%, making it a popular option for income-focused investors who want exposure to US markets. However, it does come with a trade-off. The upside potential of the underlying stocks is capped because Jappy has already sold the rights to profit beyond a certain price level. This means Jappy prioritizes income stability over high capital growth. Historical performance insights. How Jappy stacks up. Now let's talk about performance. Because what's an investment without looking at the numbers? But as always, please note that past performance does not guarantee future results. Year-by-year comparison. Here's how Jappy has performed compared to its benchmark, the S&P 500 index represented by SPY ETF, over the past few years of its existence. Note the returns cited include dividends. In 2021, Jappy delivered a total return of plus 21.53%, which is impressive, though slightly below the S&P 500's plus 28.73%. This reflects how Jappy's covered call strategy limits gains in strong bull markets. 2022 is where Jappy shone. While the S&P 500 plunged minus 18.17%, Jappy only declined by minus 3.48%, thanks to its income generation and lower volatility. For defensive investors, this resilience was a major win. In 2023, Jappy returned plus 9.82%, again lagging behind the S&P 500's plus 26.18%, as the market experienced a tech-led rally. This underperformance is painful, but keep in mind that the objective of investing in Jappy is more on long-term, stable performance. For the year-to-date 2024, Jappy has gained plus 15.49%. Compared to the S&P 500's plus 28.32%, highlighting how it performs steadily but may underperform in euphoric bull markets. In terms of dividend yields, the yields of the US-listed Jappy range from 6% to 12% over the past 4 years after it has been listed. The dividend yield of the LSE-listed Jappy is 7.53% for its inaugural distribution in December, showing its dividend potential. Performance in different market conditions. Let's break it down further into how Jappy could perform in different market conditions going forward. 1. Bull markets. Jappy tends to underperform during strong bull markets. The covered call strategy limits upside potential because the premiums collected offset some gains, and the upside is capped. 2. Bear markets. During downturns, Jappy's strategy provides a cushion. The premiums from covered calls and dividends can help offset losses, resulting in smaller declines compared to the broader market. This makes Jappy appealing for defensive investors. 3. Flat or sideways markets. This is where Jappy truly shines. In stagnant markets, where prices don't move much, Jappy's income generation through option premiums and dividends can deliver steady returns, outperforming traditional index funds. Another key advantage of Jappy is its lower volatility compared to the broader market. For example, in 2022's bear market, when tech stocks saw wild swings, Jappy's focus on low volatility stocks and its income strategy helped smooth out the ride for investors. I'm repeating myself, but while the S&P 500 dropped -18.17%, Jappy did much better at -3.48%. This makes it an excellent choice for those who value stability alongside consistent income. Why the LSE listing is significant for investors. If you've been following my videos, you'll remember that in my recent video, I discussed how valuations in the US market are hovering near historical highs based on the Shiller's PE ratio. Take a look at that video if you'd like a deeper dive into what the Shiller's PE ratio is. Some analysts believe that this indicator suggests that US stocks might be quite overvalued, increasing the chances of a bear market or a flattish market in 2025. If such scenarios come true, Jappy's income-focused strategy could make it a good alternative for dividend investors. While the broader market might struggle to deliver returns during stagnant or declining periods, Jappy's covered call strategy is meant to generate steady payouts even when stock prices aren't soaring. Investors looking for stability in income, especially when market conditions are less favorable, may wish to consider Jappy. Now, here's another reason why Jappy's listing on the London Stock Exchange or LSE is a game-changer. Previously, when Jappy was only listed in the US, Singapore investors faced a 30% withholding tax on its dividends. That significantly reduced its appeal. However, the LSE listing is domiciled in Ireland, meaning there's zero withholding tax for Singapore investors. This opens the door for us to fully enjoy Jappy's high dividend payouts without losing a chunk to taxes. That said, based on the December 2024 distribution, the dividend yield for the LSE-listed Jappy appears to be about 10% lower than its US-listed counterpart. This could be due to differences in fund structure or timing of distributions. While this is something to monitor, the elimination of withholding tax still makes the LSE-listed Jappy an option worth exploring for income-focused investors. In short, with zero withholding tax and Jappy's income-focused strategy, some investors might find that Jappy's approach aligns with their financial goals and consider exploring it as part of a diversified portfolio. Considerations and risks. While Jappy offers several advantages, it's important to keep potential risks in mind. 1. Capped upside potential. As mentioned, JP's covered call strategy limits capital appreciation during strong market rallies. Hence, some analysts caution that over the long term, covered call funds may not be the best buy-and-hold investments for investors with a longer time horizon. 2. ELN counterparty risk. Jappy uses ELNs to implement its covered call strategy, which introduces a level of counterparty risk. This means that if the issuer of the ELNs fails to meet its obligations, it could impact the ETF's performance. 3. Currency risk. Jappy is denominated in USD, so investors need to consider the potential impact of currency fluctuations on their returns. For Singapore-based investors, Jappy's USD denomination means that your returns could be affected by movements in the exchange rate between the USD and SGD. False sense of security. Some analysts describe JEPI as having lower volatility and can outperform the market during a bear market. However, during the recent market volatility in August 2024, the S&P 500 Buy-Right Index, a benchmark for covered call strategies, dropped 2.8%, which is only marginally better than the S&P 500's 3% fall. This does not offer much additional protection. However, this has not taken into account the dividends that investors can receive from Jappy, which can help to mitigate the price drops. The Dividend Uncle's take. Now, let's talk about how I personally intend to use Jappy in my portfolio. But before I continue, it's important to remember that everyone's financial situation is different. What works for me may not work for you. Now, for me, holding a diversified portfolio is key. Jappy plays a role in my dividend stocks portfolio, alongside REITs and growth stocks. I consider Jappy's diversified base of large-cap, value-focused U.S. stocks could provide mitigation to concentration and valuation risk. Plus, its monthly payouts helps provide a consistent cash flow, whether it's for reinvestment or to cover expenses. Most other dividend stocks and REITs pay dividends on a quarter or semi-annual basis. In summary, Jappy's listing on the London Stock Exchange is fantastic news for Singapore dividend investors. With its high yields, steady payouts, and now no withholding tax, it's an option to consider for generating income. While it's not perfect for every investor, Jappy offers a combination blend of stability and income, making it worth considering as part of a diversified portfolio. What do you think about Jappy? Will it find a place in your portfolio, or are you sticking to traditional dividend stocks and REITs? Let me know in the comments below. And if you found this video helpful, give it a like and subscribe to the channel for more insights. Until next time, happy investing!